So Travis, nice to see you, brother. How you doing?
Too. I'm doing okay. How are you doing?
Awesome. Well, we're here to do a presentation on something that you're very dear and close to. I think you spend about 60% of your life looking at metrics for companies. So you want to start us off? And this is what we're trying to do is just talk about the metrics that people need to monitor in their business and maybe some good rules of thumbs for people to have, right, to look at. So especially, the economy still seems strong in some areas, still some weak in some areas. So with some uncertainty, people are really wanting to learn how to watch their business a little closer and what to look for.
Yeah, absolutely. And this title says 4 metrics to watch, but the truth is there are so many that it's hard to boil it down. So there's going to be some broad areas of conversation, and we'll probably get into some more details as we move along. But just be aware that 4 might be a little misleading, and honestly, it's probably a little different for every business that you're in. So we'll branch off a little bit. So to get us started, the first thing that we probably want to talk about is just in general cash flow. Right? We're talking about economic uncertainty. Everyone knows that cash is the lifeblood of our success, right? Without it, we're going to be strapped, right? They call it cash strapped for a reason. So if we think about that, Mike, what is, this slide kind of tells a story, but a good rule of thumb for maintaining an amount of cash in your business for regular use and also for reserves.
Right. Well, that's a question we get asked all. How much is too much cash and how much is too little cash, right? So generally, you're going to have a rule of 10 to 30% of your annual revenue, right? And it really depends on certain factors, okay? The biggest thing when you look at, that's a big range, right? I mean, that's a pretty wide range, right? 10 to 30%, right? So you're always going to be looking at how reoccurring is your revenue. So high reoccurring revenue, and reoccurring revenue could mean like an accounting business where you have reoccurring revenue with clients, or if you got contracts in your business, is a lot of your contracts over a longer period of time, that's got a secure revenue. So you're looking at high reoccurring revenue. And then if there's no reoccurring revenue, really the question to ask is how quickly can things get really bad in the business, right? We work with a lot of construction companies. With that said, we talk a lot about construction companies, right? And one of the biggest things, or even service-based company, how quick can the cash turn off? And then depending upon that is the percentage reserve. Now, what's nice, if you talk about a service business, growing a service business doesn't really involve a lot of cash flow, while growing your average construction company or even a retail business or distributors, you're going to eat some cash. You can eat some cash really quick, even though you're generating a lot of profits.
Absolutely.
I
was just going to say, what's the adage you use? You grow yourself into bankruptcy.
Oh yeah.
Right.
So let's talk about some of these high recurring revenues. Obvious. Hey, 10% if you got super high recurring. Accounts receivable. If you've got net zero, if you're not accounts receivable business, then you could go to 10%. If you're a high accounts receivable, 30%. And I would even say if that accounts receivable is concentrated with a few customers, you're going to want more cash. Let's talk about pipeline. We work with a lot of business owners that are just starting really to spec out pipeline. But pipeline, and we'll talk a little more about that, is what's on the crest of becoming business. Like, a lot of times the activity you're getting, or different things like that. And then of course, high growth business, you're going to want more cash. Big purchases, if capital intensive business, you're going to want more cash. You tend to be, if one owner business, again, you can go on the lower end and 30%. And why is that? Because a lot of times, if you really want to piss people off, make a capital call, right? So the thing is I mean, so
Truth.
that's the truest statement ever said. There's always going to be, if there's one partner, generally the one partner, he's completely responsible for the mess that he's made in the business and perfectly willing to put the money or one into the company. And then how strong are the owners? And then, of course, client concentration is a big issue. High concentration, one client, and then, of course, high amounts of accounts receivable, low amounts of accounts receivable.
Yeah, so that gives you a lot of things to look at. And obviously, no one company is probably going to fall in one or the other. But if you do, chances are you're going to see yourself fall, with similarities to these. So just keep an eye out. And
Right.
that's something we can kind of look into. Now, we talk about an amount of cash to keep. There's also the idea of keeping multiple cash accounts for various purposes.
Right.
And these are just some options that are pretty broad to be used.
And these become really important now because of the interest rates, right? Generally speaking, and another thing that people need to look at is sweep accounts. Sweep accounts are actually now, with the interest rate being higher, they become more feasible. There was a period of time where even if you had $2 or $3 million sitting in your operating account, that sweeping didn't make sense because the cost of the sweep really was eating up all the interest. But now that you can get 2 to 3%, even 4% in some cases, you want to look at, hey, setting up a sweep account. The same thing with your reserve account and your tax reserve. You generally want to use money markets. We're big believers in segregating your cash, especially because too much cash in a business, if it's not segregated, creates a lot of problems, right? And people are like, and the problem is we tend to overspend if we have too much cash sitting in our operating account.
Comfort.
Right. And a lot of times too, because of that large amount of cash, I've seen business owners make really poor decisions and really not realize the pain of losing money until all of a sudden their reserves were way down. Cash is a lot sort of like we used to use the analogy of, hey, cash is like water in a river, right? So if you've got a riverbank that's flooded, you're not going to see any of the rocks. You're not going to see any of the problems. You lower that, you're going to see all the inefficiencies in the business. You're going to start looking at the expenses in a different way and start seeing the business in a different light. So, that's another thing that you could say for inventory too. A lot of inventory sort of could hide your inventory problems.
That makes a lot of sense. And one way, we're talking about how much do we need? It's one thing to say, having too much can be an issue, but where do we kind of place that watermark? And this is just one way to determine that. And it's really simple. You have a year of revenue and divide it into a daily number, and determine these fun cash flow metrics here, days in accounts receivable and days in accounts payable. And you have a formula to determine the amount of cash you need to keep on hand. So it just tells you what needs to be in your operating account, right? It matches up with your operating cycle. So in this case, it's telling us that at $3.5 million a year in revenue, with about 45 days to collect your receivables and about 5 days to pay your payables, you're looking at about $384,000 you need to keep on hand. So that's just one method of determining this to kind of see where you need to be in general.
And that would be almost the minimum level, that 349.
Yes,
right?
exactly.
That's the minimum.
It really, what it kind of matches up with is 2 payrolls and a small operating reserve is kind of the comparison that's supposed to make. But then in addition to your operating cash, we also have the tax man breathing down our neck.
Yeah, that's always a controversial subject, right? With the business owner. So taxes. And we always, hey, but taxes also, or tax planning, generally going to require cash. So you always want to have a percentage of net income. If the business owner is taking all the net income out of the business it's really going to be hard to do tax planning with that client. Why? Again, 40% of forecasted net income in the tax account, that's a pretty high number. You could go lower than that. Actually, if you're a business in South Carolina, qualifies,
Sorry about that.
no problem.
No problem.
Qualifies for QBI, generally, or qualified business income. The top rate for businesses in South Carolina is right about 31%. That includes the South Carolina income tax, and then, of course, the QBI. Now, there are, of course, add backs and different things like that. So, generally speaking, you're going to want to hold 40% of your net income for tax planning and for taxes, and just reserve that.
Now, this little illustration here is saying that you're going to maintain all of this cash to pay your tax burden. But like Mike's saying, you've got other options that you can use that for, but it does need to be available. That's the key.
Right. Yeah.
And with that, we've got our operating and reserve, tax reserve, and also line of credit options, and other sources of liquidity that you want to have available to you in a pinch, to create that capacity with your cash.
And one recommendation on the LOC, line of credit, always be trying to get your line of credit improved. And then also banks are starting to offer 2-year products where you don't have to renew the line of credit every year. 2 years is a good number if you can get that, especially, most of the clients here in Greenville, South Carolina, have coming off great years, 2022. So it'd be a good time to get your line of credit increased and also get your line of credit for 2 years. Most recessions, especially in our geographic area, don't last over 2 years. So, your lending base will not be challenged for that 24 months.
Yeah, and that's like I said, it creates capacity for you. And in addition to that, there's other levers you can press or pull within your company. In this instance, we're talking about accelerating accounts receivable collections and the difference it can make with how fast you can collect on receivables. Again, this is going to be industry specific, depending on what your business does, what your typical systems and processes are as well. But you can see that if you turn it up quicker and you get paid faster, typically your cash flow is going to improve. In the same way with if you can extend out your payables, or maintain, or what's the word I'm looking for, manage your inventory a little more effectively, you'll see it, improved cash flow. This chart is just here to show you the impact that it can make.
So this is just to share the numbers with someone, if you're 60 days, if it takes you an average of 60 days to collect your AR, this is going to be, you're actually going to go negative in cash, right? A little negative. Right. And then you'll go up to right about $120,000. It looks like. Well, if you were able to just take that down 15 days, when you avoid the negative and you're going to somewhere around 210, right? Am I reading?
Yeah,
and of course, if you turn it to 15 days, you're never negative. And nowadays, I've seen a lot of businesses with almost zero accounts receivable. Or they're, sometimes we're offering discounts and different things to get the receivables, but having money out to customers is one of those things, especially, one thing we've seen actually with a lot of our clients is we've seen clients with lots of cash, but inability to get inventory.
Right.
So if you're in one of those businesses where there's great demands, you should tighten up your terms. You should look at that, because replacing some of that stuff is harder. Now, supposedly that's starting, especially I see in construction, we're starting to get more and more of the pipelines becoming available, construction materials and stuff. So, but there's still some shortages out there.
Oh, absolutely. And again, this is something that you just want to maybe manage on a regular basis. Just keep an eye on that as one of your, we're talking metrics. this is probably something that you want to keep your finger on the pulse, just to see how fast we're collecting, how long it takes us to pay, and how we manage inventory, because of how close or how much those can affect cash flow.
Right. And a spike in accounts receivable days will really, really should, business owners see that it is a good indicator that some of that might be bad.
Oh, absolutely. Yes. And with that, you use a lot of different things to forecast. And in this instance, a lot of this is built around, a service company.
Mhm.
But let's just think about how some of these variables can be tweaked just slightly, to be a little more broad, a little more general,
Right.
because this is how we get revenue, and then we use those things we just talked about to work on cash flow.
Right.
So, in this instance, we're talking about what's available to us from our
Right.
staff,
Hmm.
and how can we best use our staff or other resources to generate revenue and project that into the future.
Correct.
And I'm going to just skip through because I like this table a lot personally. So, for a service company, the most precious thing that you can have is time,
Right.
right? So our non-weekend days a year is the starting point, and we have working hours, and then what are called, kind of an industry term, culture hours. And I'll scoot down there to that, because these other are a little more self-explanatory. Culture
Mhm.
hours are time that your staff is working that they can't be productive to generate revenue, right? Whether
Correct.
it's holidays, PTO, um, training or
Mhm.
educational time, all those
Mhm.
things come out of your available working time. And that leaves you with available hours. And, as I was thinking about this could be really anywhere. I took it in the form of a retail store, and I thought if I had 1,000 square feet, but I need to convert 100 square feet into a storage closet, that's no longer sellable space.
Right.
So, it kind of works the same way. Whatever your metric is, we can get to total available revenue generating units.
Mhm.
That was how I took this down. And if I were forecasting for you, I'd do the same thing.
Correct.
We would find that one piece and try to lever that as best as we could. So with that, and I don't want to rush you through this, Mike. So if you
Oh,
want
no,
to,
you're doing good.
okay.
Well, yeah, I think of, a lot of our businesses, it is very labor, generally speaking, other than cost of goods sold, right? Let's say you're a distributor or even in a retailer, but your biggest expense or your second biggest expense is labor, and how do you utilize that? So a lot of times with some key metrics for a retailer is, hey, what's our gross margin per labor dollar, gross profit per labor dollar, right? I've seen some retailers that pretty cool software that kicks a nice little P&L every shift, right? Hey, this was the gross profit, boom, and this was our labor. And so you got gross profit dollars per labor, right? Sort of one common labor metric we use is, Travis, remind me,
Labor efficiency ratio.
labor efficiency ratio. You only say it about 10 times a day, but it's how efficient are we using our labor? Because that's really the key metric. And nowadays too, what I always sort of look at these hours, and this is the reality of today's labor market is, for law firms, what they're finding is, hey, you can't really expect, there are law firms out there, they still have it where this is the billable hour quotient, right? They expect a lawyer to bill 2,080 hours. Well, I mean, if you don't have any time for anything, well, you're expecting people to work 26 or 2,700 hours to get that. And it's just not going to happen anymore. So the newer companies are finding ways to create more impact with less hours.
No, and that makes a lot of sense. Especially considering this next slide where we talk about available hours and then
Mhm.
what you call an expectation, right? Of how much of that available time should be revenue generation.
Right.
And in this case, they're saying 75%. and it probably is going to be different depending on the company, depending on the situation. And we're left with what our billable hours or our revenue generation time is going to be. So, and in doing so, and I can't remember. Yeah, we know what that is. Thank you for the math. We're left with the utilization rate, how we're using our available time and our total time for our staff, right?
Well, and if we were talking about, let's just take this and say we're talking about a heavy equipment company.
Okay.
Utilization, realization, same thing, except you're adding a piece of equipment. You're adding a piece of equipment to the mix. Usually you're bundling your equipment with the driver saying, hey, this is what we're shooting for, right? This is what it costs us. This is what we're shooting for. But it all comes down to, I mean, in a theoretical world, hey, if we build 100% of our people, right? This is what we could expect, but we know we're going to have rain, right? Instead of culture, you could put rain.
Maintenance.
Yeah. You know, you're going to have downtime on equipment, right? You know, you're going to have all this stuff, but the goal is, you know, we talk to a lot of construction companies, and the biggest number, what we say is, hey, the most important number for you to know is how much cash you're going to have in the bank next year. Because you could grow, you could shrink, you could lose money. And in construction, because of the inventory, because of different things, there's just this wide range of cash that you have to account for. And you know, especially when you're talking about some of these heavy pieces of equipment. Same thing with builders. Builders, you know, they're really taxed inefficiently. The government really, I mean, if you're a pretty large home builder, you know, it's interesting that you can pick up significantly more taxable income than you can cash, especially if you're not careful. So.
No, it it makes a lot of sense. It's like we talked about a little while ago. You know, in terms of we see income, but where's our cash flow? Right? You said it. I mean, that's and with the heavy equipment, where you're really talking about that phantom income with depreciation and the debt pay down, right?
I mean, yes.
We won't get too deep into that right now. But this is just another way of, you know, we're looking at our rates on how to project off of these things. And the same thing would work off of hourly or billable rates with any other metric that we're using. This is just, if you've got a write up or a write down, or if you've got a discount or some other reduction, all that's doing is applying that to your standard rate, and you have an average billable rate. And I know this is step by step to get to here, right? For an individual, whether it's a staff member or a piece of equipment or whatever it is, we're working to get our billable hours times our average billable rate to get our revenue per individual or per unit. And that's that forecasting, right? We've been saying forecasting, we've been doing a lot of math, so I apologize. That's how we forecast out for an individual. And from there, we can forecast to a team. And at that point, your team, or you know, otherwise could be your entire business, whatever it happens to be. And you may have you have several pools of these depending on what you're doing. But in this case, we have went all the way from an individual and how much time they have available, what they get billed at, and potential discounts to get to a full team at $3.5 million a year for a forecast.
Right. And usually the revenue model on forecasting is the toughest part of a forecast. Wouldn't you say, generally speaking?
I would say so. It's one that I typically can't do alone. You absolutely have to have input to get there and do it right.
Yeah, it's really critical to get that revenue forecast correctly. I mean, and nowadays with some of the, you know, interest rates are all-time high, right? Inflation's still pretty high. Wages cost is going up on a regular basis, right? That revenue forecast is real critical, but at the same time, you got to be flexible with it. You got to realize that, hey, some things are going to happen, right?
Yeah. Well, and you need to be able to, like you're saying, be flexible and have the ability to maybe have 2 or 3 different variables that you're dealing with.
Mhm.
Whether it's in the last case we were just talking about, is it the hours, is it the rate, or is it the realization? I mean, what all those things are going to come into play, and it's not as simple as I wish it were that simple to throw it in there and say this is what it's going to be, but we all know there's a lot going on, and it all leads directly to looking at more of our financial statements and how it looks in the future.
Mhm. Correct.
And you know, again, these are things that are all going to be a little bit different depending on who we're talking about or who we're talking to, which is why what should your net income be? The truth is, it depends.
Right.
Um, I don't like anything that gives me a range like that because let's think about a convenience store. I mean, what should their net income be? Probably maybe 4%, 5%.
Mhm.
I mean, it's a stretch to fit everyone inside this box.
Right.
Um,
However,
so
as an entrepreneur, you really should be shooting for a minimum of 10% net income. I mean, the thing is because it's really hard to, if you start cash flowing a business with a 10% net income, if it's tough to grow with that level of income. I mean, especially if you have accounts receivable, if you have a gap between how quick I got to pay my payables and how quick I get my accounts receivable, it's really going to be hard to grow. You're going to need to put a good bit of cash in there. You're going to need to really, really watch everything because you could really run out of cash. And I mean, entrepreneurs do some crazy things. I've seen people grow businesses with that type of margin now. I don't know. They probably lost 3 or 4 years of their life dealing with the cash flow. Probably a year of my life for me dealing with it, and it wasn't my business. So you can always grow, but the thing is there is what we call in the business sustainable growth rate. Okay, and that's something. How quick can the business grow without outside capital? And at 10%, it's pretty hard, especially if you're anywhat capital intensive. Service businesses, generally, if you do a good job of collecting your money, maybe getting retainers, you could grow at a 10%. At a 10%.
And there you go. The same thing kind of applies back to that table we looked at before. Depending on these factors, you probably could be on the lower end. So yeah, exactly. I mean, that makes a lot of sense. All that kind of ties back in together a little better than I expected. So nothing wrong with that. um, so thinking about your P&L, things we want to keep an eye on. Again, this is set up to be more like a service company, but let's just think about it. We tell people a lot about simple numbers, and having your financial statement set up in a simple manner. Production is as simple as saying your labor, essentially all of your labor, including this burden number, right? Where we're talking about all of the overhead costs that really should be attributed to labor, in addition to benefits and payroll taxes and things like that. We also have, this is how they calculated burden rate in this exhibit. All these things listed through here. We've also got gross profit, which is as simple as revenue less the production. Again, service company and a construction company, you're got materials up there and everything else that goes in cost of goods sold. But in terms of overhead, we talk about simple numbers again. Administrative is what I would typically call other operating expenses.
Right.
But it's everything that's not labor, marketing, or facility. And you can see some examples out here. Marketing, again, and they're mentioning payroll and payroll taxes with these.
Well, that's more, explain that. That's more, if you have a marketing team,
exactly.
Sometimes we put marketing expenses right to that marketing expense. Even, we've recommended that with a few companies that, hey, let's sort of start getting the marketing labor into the marketing expense. So you can see what it's actually costing you, because a lot of times, people just don't know what it costs to acquire a lead, right?
That's a good point.
I remember watching Shark Tank one time, and the guy had a pretty decent business, had a good grasp, but then Mark Cuban or someone just asked him some questions on acquisition costs and this and that, And the guy, it was an internet business, and the guy didn't know the numbers well enough. And they
Evaporated.
rolled on him. And here's the truth. 90% of us, including yours truly here, we don't really know the cost of acquiring a customer. So trying to figure that out becomes, it really, especially if you ever want to scale a business and grow it rapidly, the cost of acquiring a customer becomes very important. And that marketing would be part of that cost, right? Because getting that awareness, so that's becoming more and more as companies get bigger. They'll see if you start bringing on a marketing professional, putting the payroll there.
Well, and I should have mentioned the same thing was listed in administrative. Whenever I said labor, it's production labor, that typically is your direct labor, right? That's the term a lot of folks use. But moving through to facility costs, this to me is the simplest one that we look at. What does it take to to be in your space? And some that aren't mentioned in this list that probably should be would be things like telephone and IT, things that are set for you that you have to do your work.
Right.
Including software, things like that. I would probably include that with facilities in general. And then the last item, I didn't want to get into too much detail, but we need to consider owner comp.
Right.
So we have net income before our owner gets paid. And then we have owner or shareholder compensation to get to an adjusted net income number. So that's something that, typically we do it the opposite way, right? We typically have our net income and we add back shareholder compensation. And you'll probably hear us say the words seller's discretion earnings quite a bit. That's what we're talking about. The total amount that's available to an owner or a shareholder.
Right. And seller's discretionary earnings is one of those, it's an important measurement of income for your smaller businesses. And it's generally what a smaller business, and we say smaller, probably $5 million revenue or less, possibly going to be one of the multiples that people will look at is that seller's discretionary earnings when they're looking at buying a business.
Moving on to this next little piece here. And again, moving kind of quick. So if we need to go back and hit something a little harder, please let me know. And I'll stop driving so fast. Thinking about job profitability, this is one I'm gonna move through relatively quickly because it's pretty specific. But in this case, this slide isn't. Job revenue minus total job cost kind of fits anything in production, right? Whether we have a project that we're working on as a consultant or in construction or anything like that, that we can directly attribute cost to a job, we can start thinking about this. In this case, we're talking about, hey, what's our anticipated profit on a job? This is our average bill rate minus our cost per hour, divided by our total revenue to get a profit percentage. And you can look at this by job. And, again, with construction, I think that's probably a great thing to do. That's a whip schedule, right?
Yeah. Construction becomes really important because what you want to be careful of, and we saw a lot of this in COVID with the price increases. Well, there are certain people, you just do a blanket price increase. And what happens is the market's sort of smart. And what we started to see was the houses that were really not that profitable, even though we were doing blanket price increases or different things like that, or jobs. You really need to, when you do your price increases, you really need to know what's profitable, what's not, because what you want to steer through your price increases is you want to steer your customer to your most profitable project, right? So the thing is, if all of a sudden you just do a 3% blanket price increase on all your stuff, and you still have a very low profit margin service, you're going to get more of that service. So, I mean, that's why, we're big believers. One of our core values is Pareto. And Pareto says 20% of your customers are going to generate 80% of your profit, 20% of your customers are going to create 80% of your problems. It's okay if those two line up, right? They generally don't, but it's okay if the 20% that generate 80% of your problems create 80% of your profits. That's not a bad thing because they're demanding, but they're probably worth it. But a lot of times what we find is that it's not the case. So measuring that job profitability and then strategically looking about how do we get more of this and less of that is really a key way to do that. And we were actually pretty impressed. We were looking at a QuickBooks the other day. I mean, QuickBooks Online is not the best job costing software in the history of the world. There are a lot of add-in programs specifically for construction stuff that do a better job, but it does have some it's actually improved some where you can measure some of your job costing. And then of course there's, what we see is a lot of industry specific softwares that help you. Like we use an industry specific software that enables us to track our utilization or realization and our job profitability.
Right. Which, this is listed as clients, but you could think of this as individual jobs, individual projects, individual products that you're trying to measure on this. The whole point of this discussion is metrics. And if it is, gross profit per product or per service, it's something worth keeping up with and that you can track on a regular basis. And these are all, it's all the same thing, calculated different ways, but we're all looking at the same thing. We've got a goal. Are we meeting our goal or are we not? And this is something you can measure on a regular basis. Again, this is the same thing we've been looking at. I don't want to belabor that too much.
On revenue recognition, I mean, I think the biggest thing, revenue recognition can be important for, especially for, I think, in service-based industry, it's okay really to recognize revenue based on billing, right? Except you will have some distortion. Even we've started moving where we recognize a percentage of our unbilled labor because of the distortion we would have in months, right?
Yeah.
But the biggest thing we see is in construction companies, you really want to be specific on how you're going to recognize your revenue on a monthly basis. Which, Travis, before we leave this, I really want to talk to people about the goal of this is really, as a management team, anyone who's a management team, you really want to have a really organized monthly financial meeting that covers some of these things and brings to the owner's attention. You want to start with job profitability. If you have a forecast, you want to look at your forecast compared to the budget. And then it would be great if you had a customer profitability analysis. Because sometimes where we've seen on the forensic side is you'll see one job profitability analysis for one supervisor is significantly lower, and it's some type of kickback scheme. So that's why you always want to look at your job profitability in several ways. You want to look at it by, by customer, by supervisor if possible, and just figure out why is one supervisor getting lower profitability than the other. But you should all pull this together. As a rule of thumb, what we always, when we coach people, is you should have a monthly financial meeting that really has an agenda and goes over these things. And your financial guy, a lot of times Travis serves as that person or I serve as that person, goes over these specific numbers on the agenda.
Yeah, and part of that agenda that you're talking about, it could just be a really simple dashboard, where these things are apparent and you're looking at the last small trend, whether it's 3 months, 6 months, whatever it happens to be. And that's just, it doesn't have to take long and it doesn't have to be an involved process to get those numbers together necessarily. But if you are looking at them and talking about them, it's kind of like with a budget. The main hurdle is to have one. And if you can have this dashboard, that's the hardest part, because then you can just talk about it for 5 minutes. But yeah, so revenue recognition, important. It's gonna really impact your financials. But something else that really impacts your financials, especially when we talk about the future, is something Mike mentioned earlier in the pipeline.
Right.
And pipeline can be something that is relatively simple in knowing, the jobs that you've got lined up, or the leads that you have that are out there. But it can be really powerful. And actually working on this opened my eyes a little bit on how powerful that pipeline can be. This is a really simple equation here with our contracted work over how much work we can do is our
Mhm.
capacity. And here's some, if these were our clients, man,
Could be in trouble. Walmart puts the squeeze. Notice Walmart zero. They
yeah,
probably
yeah.
threw the guy under the bus.
But just looking at these, hey, we can do over these 3 months, we believe, 780,000 in revenue, and we have contracted 512, meaning we've got a third of our capacity that's underutilized right now. And how do we get there? And I really like this because you can see in our current month, we're good. We're okay, 90% utilized in our capacity. But these next 2 months, that's where you've got some work to do.
Mhm.
And looking at these next few variables, that's going to show us a little bit of how this works. And I'm not going to bore anybody by reading through these. We can do a separate thing on how to do this calculation sometime. But these are some of the variables that go into how to determine your ideal pipeline size.
Right.
But with those things being, how long does it take to get through your pipeline from sales lead to close? How long does the contract last? And how well do you close your leads? Those are the three things you're really considering to get there. And it looks something like this. Let me get there. Pipeline needed, right? To get that number, we need to get $350,000 in the pipeline.
Mhm.
So that, to me, that speaks to someone like you, who's going out there and trying to get this, get these leads, generate the meetings, get in front of people to be able to
Mhm.
know what our measurement is. Because a lot of times that goes up in smoke, whereas I'm just trying to do as much as I can, as fast as I can, even when it's not necessary.
Yeah, Travis knows, fortunately for accountants, we've been sort of at capacity, but Travis started when we used to have a lot of capacity. And we'd be like, oh, we're going to take this job. It should be easy money. And basically, so don't,
Yeah.
and ended up not regretting it. But
Yeah.
pipeline is one of those numbers that's really important. And it's really good. I mean, to track it historically, because especially if you're in a non-reoccurring revenue, or if you got a lot of moving pieces, right? So you've got a lot of moving pieces, right? Let's say you have 3 crews with 6 pieces of equipment, and you're just sort of you've got a lot. You've got to, okay, this job, start date, and try to figure out how to manage your capacity at the same time, recognize pricing. I mean, especially if a lot of the jobs, we work with a lot of construction companies, are bigger jobs, right? And so if you're expecting to get a bigger job and all of a sudden it cancels, that's what we're seeing some of. A little with some is we're seeing some of these jobs cancel or be delayed because of the high interest rates. So planning out your capacity in an ideal world, you would have a really good idea of what you need to do.
Yeah. And with that, with our jobs getting delayed, you can look at that a few different ways. We talked about all those different variables. So I mean, if your sales cycle just gets increased, right, we can see what happens. Or if it gets decreased in this case, what happens to the pipeline needed. In the same way that, if it just increases the length of our contract, then we can see, if it doubles, then it doubles our pipeline needed. All things considered, you can kind of see just how this can work, where you can edit on the fly as the circumstances around you change, and know what to do from there. these are just some scenarios to think about, not necessarily metrics, um, but you kind of use all your metrics to get here. So this is almost some application, and I'm not going to get into number 4 because it's just it's a it's a lot to think about with number 4 with investment. Um, but if we thought about scaling up our business,
Right.
because you know, let's think about our original analysis where we were talking about an individual, right? We're going to add one person. That's probably the simplest one you can do,
Right.
right?
Exactly.
Um, if we tack one person on, we can expect to see, 600,000 additional revenue. We got to pay them. Um, there's our impact. Actually,
Oh,
they're adding
that's
3
for
people.
3 people, right? I was
That's
about to
3
say.
people. Yeah, not one. That's
Wow.
3 people getting added here.
I had one person, 617,000. Sign me up.
Yeah, they're worth it, right? Although, are they? It's 2 to 1, I guess. LER. That's pretty good. That's solid. Um, so business development, you mentioned earlier, maybe adding a marketing person to your team,
Mhm.
and what that could look like. Notice that we do have some additional stuff here for changing the owner's compensation. But
Mhm.
you can see scaling up and adding a business development person. So there's our revenue we talked about, the production revenue, but also we've got a marketing cost right here that we add.
Mhm.
So, but we can see the change, um, where our net income goes down 150,000, but that's the difference.
And in some cases, we've seen people make bad hiring decisions and do stuff. But the biggest thing I always try to tell clients is, especially when it comes to taxable income, one of the key best investments for most business owners is their business, right? A lot of times we get distracted and we spend money or we invest in all these, things that we might not understand or things that we don't know. But a lot of times, hey, getting a really good person in your business, I've seen it over and over. The dividends are huge. I can't tell how many clients I've talked to and I've really lectured them on, hey, you need to spend some money. You need to get a good person in this seat. I wish I'd gotten paid for the advice on the money they made on it, but we're like, oh yeah, that did make a big difference. Because business owners sometimes think too much about the cost and not enough about the investment. Conversely, in downturns, what we're about to talk, scaling down is sometimes the best alternative, right? It's the only alternative we see. If you have a market that's dropping pretty precipitously and there's nothing you can do, that's why that pipeline is so important, because then you can either, hey, we've got this big gap in our pipeline. Let's work the business development side. Let's see what we can do. Maybe lower our prices strategically. Let's call our top customers, see what type of work we can do. Let's try to fill this production gap. And then if that doesn't work, let's figure out how we can scale back our expenses.
And in this instance, you can kind of see what that looks like. Um, this column remained the same, but at the same time, we've also got a reduction in revenue and a reduction in production costs
Okay.
for that employee, or the employees are necessary, which I think would be 3 here.
At 3, or it's probably 5, right?
I think it just depends. I'm thinking about the 200,000 a year.
No, it's 4. You're right.
Yeah.
Oh, yeah, you're probably right. Yeah, the production.
But it's just one of those things you can do. And again, everybody's going to be different. Nothing is as simple as doing this math. There's a lot of things that go into it, but your options are there. This is just one of the scenarios that you have to consider. And really, it's just a combination of all the things we've been talking about. And then that 4th one that I mentioned earlier, investment. This could be, something that we're talking about with, if you're going to purchase a new warehouse,
Right.
that could, expand your opportunities, but also mean you have to staff it. There's a lot of things that go into the investment scenario here, which we're
Well,
getting pretty
sometimes,
close on
like I
time.
said, investment, we look at a lot of it, of business owners, sometimes acquiring a business. The people, the stronger businesses, sometimes in downturns are able to acquire, you can always acquire some business, some sales. That's where, investment can be really good, because you can, a lot of times, if there's a business similar to you where you can pick up the sales, maybe you have duplicative administrative expense, so you just eliminate expense. But nowadays, what we're learning is when people are looking to acquire companies, the number one thing they're looking for is really labor at this church. That might change, right? They're looking for a team. They're looking for team. Even in our industry, the CPA industry, a lot of CPA firms traditionally that would sell really quick are not selling. And the bigger firms are look to acquire. Smaller firms are only acquiring smaller firms that have a really, really good labor pool. They're not looking to acquire. It used to be, hey, let's acquire the work. Now let's acquire the people to do the work. That might change.
Well, and there's also expertise, with those people, it may not just be capacity, it may be ability, and that can be, again, a variety of different industries where that can happen.
Awesome.
And with that is the end of our slides.
Do we get any questions or? Okay.
I don't see any, but if you do have questions, or if you have comments, or anything out there, please feel free. We can always take them and answer them. Otherwise, don't hesitate to give us a call or shoot us an email. My email is travis@meilinger.us. You're more than welcome to send me one, and or berate me over my poor math skills during this thing. That's okay too. But we do appreciate everyone being on here today. Thank you.
Yes, thanks everyone. You have a great day.